Yo, 365. Mic check. Hope you guys are doing well. Welcome to another FOMC live, right? We've just got the rate that just got dropped right now. It's an easy 75% basis point. I don't think there's any surprise to that. I'm actually guessing, but I'm going to check the tape. But the markets are not really doing much right now. This is live, so please do let me know if you can hear me. I apologize for my state. I am tired, very tired. Just give me a second, guys. Give me a second. All right. So yeah, look, man. I'm gonna look at the tape right now and just review some headlines and all that cool stuff. But I think we probably got 75 basis points. Am I right? Yeah. So we got the expected, right? Yeah. So we got that upward momentum. I'm looking at Russell. Like there's that shady demand that we drew on Sunday at the war room. And these are just levels that price is going to bounce at, right? I expect prices to get broken later on. Blessings, man. Thank you for the mic check. Yeah. Is SP500? Let's go quickly check that out. I must say, guys, I'm very low energy. It's been a crazy one. I've manually added every single registered student since yesterday. Slept at 3 a.m., got all the senior traders done. Then I did everyone between about, say, 8 a.m. today until about 2 hours ago on the education group onto the new platform. So please check out your emails. I'll announce at the end of the video again. All right. So here are these weird, very short-term demand zones that we're willing to catch price. All right. There we go into these supplies. And really, I don't think we're going to get that much of a big move of the rate hike, right? Remember, we've been expecting a 75 basis point for a very long time. If anything, I would say markets just care about what Powell is going to say in the next 20 minutes. All right. So Powell is set to kind of like talk through some stuff. If you guys have ever seen me do these live streams, I pause through. I'm going to play the live stream. If I feel like there are things that I need to explain, I will pause it. So we'll lag a little bit behind. US 30 negotiation with the supply. All right, manufacturing, some consolidation with a demand level there. Very historical old trend line that it's about to make contact with. I would not be surprised if this is the December trend line from last year's first drop. All right, and US 30 is the chart to watch, right? Because it's not really as bearish as all the other indices. All right, there we go. So we're gonna see. So somewhere in here, I should have drawn a supply, but it's the second highest, right? Again, all these areas exist just for Powell right now. This is literally Powell's game. And just so we're clear, if no one knows what I'm talking about, Powell has to confirm, right, a filler that they put out. Let's be clear, right? Remember 2 videos ago, I taught on Fed pivot points and Fed U-turns, right? And I'm telling you, they use Wall Street Journal to kind of like filler, like, so they put out a filler and they insinuated that there's going to be a U-turn. And you have to think about this quite smart, right? If he's going to crush the markets today, he basically had 2 options: crush the markets when the markets were down here, or at least create a rally, right, and crush the markets when the markets are up there, which is again simple: sell high, buy low. We've seen them do this many times, right? Fed rate hike in June, July, March, same. All these rallies on your indices, all of them are literally based off the actual meeting, right, and then after, right? But don't, please, this is not a one event week. All right, remember on Friday we've got NFP with ADP today. I don't even know what that data looks like. I haven't had a look at it yet. But yeah, it's definitely been priced, and I completely agree there on the chart. It's absolutely been priced in, man. So the only thing that matters right now is confirmation that they're going to maintain an aggressive tone. So that's what we need to look out for today. He needs to keep, well, not that he needs to, but here are the 2 options. Number 1, he maintains the aggressive hawkish tone. Inflation is too high. We're going to do whatever it takes to get it down. We want inflation to come down to 2%. Because of that, we're going to keep rating, hiking rates. Now, if he is precise, because I know some reporters are going to ask him to be precise, What do you think you're going to do in December? If he says we're going to continue with the same momentum, something along those lines of 75, or even say we're going to looking to go a full 100 basis points December, that's a strong bearish signal. It's not only that, but it will also catch, a lot of people on the wrong side of the markets, right? Because a lot of people are expecting him to say, the Fed has done enough. We have tightened. Because there's going to be a lag in what we've done so far, we're going to slow down. We're considering 50 basis points. Hell, this market might even celebrate if he says another 75 basis point. Well, let me just be careful about that. But definitely a 50 basis point in December is that confirmation for a Fed pivot point, right? But long term, there's still a lot of pain, I think, to come. We're looking at stocks here, right? Indices anyways. And remember, these things are forward indicators, about 6 to 9 months, right? So I don't want to confuse anyone tonight. I will touch on this properly in the war room. But just so you know, markets price in the future. So some of us keep saying economically in America and globally, there's going to be an actual recession, an economic slowdown. Unemployment is going to go up. When that time comes, don't be surprised when the tide starts to turn on indices, right? Because indices, all they've been doing is just pricing in bad data, recession, inflation, and going up, right? Oh, damn, ADP was quite high, 239. Thanks, man. I actually haven't had a look at all. I've been literally grinding and adding everyone on the new site. Please, guys, if you're a registered 365 student, please check your emails, all right? Because I haven't even sent a second email just to explain things, but I will sometime tonight. I took a 1 hour nap. I've been up since God knows when, adding everyone manually, but I need everyone to quickly enroll because I need to close that site, right? It's just for students only for now, right? I don't want to sell the course right now. I would really want it, if you register, sure, we'll add you in, but please register as quickly as possible or enroll, right? If you're a registered student already, you're not paying anything. Let's be clear. If the site asks you to pay, before you pay, please contact me. Just put it on the group. I will see it and I'll double check to make sure. I don't want anyone paying if they shouldn't be paying. If you've paid for anything 365, last year, 6 months ago, 3 days ago, all right, the trading psychology course module, you should not pay. I don't want anyone to pay. I want you to come learn though. It's 4 weeks of incredible knowledge, but I want us to make sure that we get these technical bugs out of the way. So if I can have everyone registered and enrolled within the next 3 days, if people can spread the word, that means I can then start to upload video 1, video 2, right? Because we're supposed to start, was it yesterday? The other thing of why I'm rushing everyone on the news side is because in South Africa, about 15 students emailed my team saying, how are we going to think through the load shedding and they don't have electricity because of the government, blah, blah, blah. And so I just thought, well, might as well just use the news site, and I just dumped the recordings in there. So I'm going to be building this course with you, this module with you in November, right? So please, 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 please. The new site is built in a really cool way. I can track everything. I can track where you stopped, where you started, but I can also track who's enrolled, who hasn't, right? So I've been working on this stuff like a dog, right? You can see the people, a very few of you have enrolled, which is fine because I only gave everyone access. It was manual. I've been doing this for the last 2 days manually, all right? So some of you got access at 8 a.m., some of you got access at 6 p.m., right? Because that's just when I got to your name. But now I know for a fact that every registered student from the time I've been teaching is now on it. So we've got 2 to 3 days, guys, just to check your email, create a password for yourself, enroll, make sure you can see module 1, module 2, make sure you've got free access to it. If the site wants you to pay, let me know so I can quickly, on my back end, make sure you don't, right? This is just for those who have already registered in the past with 365. I made a promise to you a long time ago that I would teach you guys intro modules and psychology completely for free, and I want to keep my word. All right. Thanks, man. Thanks, David. Thank you. Thank you. Yeah. I completely agree. I think rates take 3 6. Absolutely, you're very right. In fact, there's like it's a common lag, right, with monetary policy. It takes 6 months for the actual economy to feel. So what we want to start to see with these NFP numbers, I'm not necessarily saying tomorrow or Friday. I can give you guys my thoughts on Friday's NFP maybe sometime tomorrow when I look at the data. But what we want to see next year in the first Q1 of 2023 is we want to start to see unemployment slowly start to go up. Right, that's when we'll know the monetary policy or the Fed tightening has now slowly but surely started to kind of like take a hold on the basic economy. Right, a lot of people are waiting for this big Bitcoin mooning event. Like I just feel like people lost their souls. I feel like I've never been and I think it's just as just part of how I am and who I am and how I was raised, blah blah blah. But I just feel like the whole market feels like the first. I can only imagine if the markets have been acting like this. This is literally the markets acting like their very first time in a strip club, right? This is just too euphoric, man. Too out of touch with reality. But again, Powell could be facing a lot of political pressure. And that's what I want to kind of like just hear from him today. We've got midterm elections in a few weeks' time, and the market is very notorious for rallying post midterm elections, very much so. So it's absolutely imperative that we understand the powers that be. But if Powell stays aggressive, which he should, right? Remember, we pretending to kicking the problem down the road is just making things worse. And I think Powell is a different type of Fed, right? The other Feds have done our market rug pulls at some source. I think he wants to bleed out the market slowly, right, so that he keeps track of that 6 months rag. But if you look at sensitive assets, right, Trevor, guys, all questions on the public Telegram group, I see them and I write them down. I literally have not had a minute to breathe. I've just been like really trying to build all of you guys into that course, and I do it manually. I don't hire people for that stuff, so I actually understand it. So I built that course, that site from scratch. Everything I did myself. So I promise to answer all those questions in there. Trevor had a great question about crypto and what I think. What I can tell you right now, while we wait for Powell, is number one, Bitcoin is recording very low volatility right now. Right, as of recently. Experts say that in 2017 and 2018, 19, right, just after that big crash, right, when Bitcoin started to record very low volatility, that was a market signal for a bottom, and markets were going to rally. That's what they're saying. I don't care. All right, I'm simply telling you that Bitcoin, as a sensitive asset, chose to consolidate the last 5-6 days, waiting for this rate hike, right? And we can see clearly there's a demand right at the bottom where the break was, and there's a big supply waiting for us at the top. I'm pro the supply as of right now, because as of right now I haven't heard a single thing that fantastic. Thanks, Uncle. Hey, okay, cool. You guys got the email. Fantastic. So I'm going to keep my promise to all registered students. Please do not pay. It takes forever to do refunds and all that kind of stuff, and I'll really avoid the team doesn't get bogged down with that. The trading flow is closing in about 13 days time, so we're really tight with reports right now. It's actually quite a crazy time. So just tell me if it's telling you to pay, and then if you've already registered before, I'll sort you out. But good to see you guys. Right, so look, man, based on what Powell's going to do, this could be the greatest fake out, which I've done tons of videos about, right? Many times around Bitcoin and crypto. This could be nice, but markets don't have to do anything tonight. Please remember this. Markets can go up tonight, despite what Powell says, only to come down because they want to use NFP. All right. Next week, we've got another CPI. Powell could go, I'm not really sure. Let's wait for another. We don't know yet. So we're going to take it step by step in our war rooms. We're going to hear what he says. We're going to mark out zones. All these zones, I've got pending orders, because if I do a war room, I just put pending orders on the line. All right. So we'll see how that goes. It could be a good week for me. Could be a bad week for me. In any case, my bigger point about crypto is, there are a lot of people, again, the first time strip club mentality. I don't know how else to describe it, right? It's just like, it's now time. it's too early to tell. But experts say low volatility. When there's low volatility and the token starts to become less volatile, a lot of people think it's time to swoop in. I think Bitcoin is a beautiful long-term investment. I think a lot of big institutions know this for a fact. I think that anything with a limited supply in the market is very, very attractive. Because of that, I believe we're going to experience a lot of institutional flow. All right. Now, because of institutional flow, I still think, although the fair value of Bitcoin might be somewhere between wherever it is now and 32,000, per coin, I believe institutions will still want to push this thing down. I'm happy to be wrong. It wouldn't matter to me. I dollar cost average every single month, right? It's literally automated. Right. So it won't necessarily matter that much, the price of Bitcoin in terms of me. But in terms of speculation, I think we still have a little bit of room to go down. It's just now based on a couple of things. I think 2023, 2024, the Bitcoin halving events are perfect moments for Bitcoin to get out of a bear market, for crypto in general to get out of a bear market. I did a scan yesterday, preparing to see if I'm ready now to do another Wealthy in 3 Years newsletter. And as far as I can tell, there are still a lot of crappy crypto projects still operating, as far as I can tell. I think we need another push down. Right, look at Ethereum, right? A short trade here. No respect for this supply. This is where Bitcoin is currently consolidating. In a previous war room, you remember that this was actually a very, very good place that I was really hoping, very much hoping, for price to respect and go down. But markets have frozen, all right? But I think Ethereum has already proven that it wants to go a little bit higher before it falls, if it's going to fall, right? So they've taken out this supply a couple of days ago. I removed it for my own trading, but in my last war room, this was a marked out supply, and you can tell it failed here, right? So we need to see what's going to happen. Price can fall from a supply, number one. Price can also create an original turn. Those of you who've done my course, please don't forget that, right? Original turns happen where the banks and institutions move first, and there's nothing that we can do. It is a turn where there is no reaction to an immediate supply or demand, right? It could be a retracement turn, so you can track it with the fib sometimes you just can't. So we are going to wait for data, right? So, we've got about 6 minutes before it starts. Please, those of you buying, I hope your stop losses are tight, all right, or your trail profits are tight, because anything goes, right? But you can tell markets have zero reaction to this rate hike, right? Normally, a confirmation like that would be negative. Granted, markets tend to rally at the beginning or fall at the beginning sometimes, and then rally while Powell is talking. I hardly ever trade live during live events, so I won't be buying or selling while he talks. I'm over that stage in my life of trading. And actually, that was a very unprofitable stage where I used to kind of like buy fundamentals and sell them, etc. Right? So what I want Powell to do is to just place the markets for me. The last chart I want to show you guys before we start is the NASDAQ 100. I'm also consolidating, behaving like a scared little kid, right? This is all in the midst of, earnings and all that kind of stuff. I'm just enjoying this, right? So here we had a supply kind of zone marked in red, right? Where I said it's a cowboy area, and then price broke that supply. I did say, if you sell here, you're going to get stopped out. On this popular group, someone yesterday wrote, buy NASDAQ 100 in full margin, right? Full margin. And it tanked. Crazy, man. Anyways, the supply was, broken a while back. This zone was yellow in my war rooms, right? And what it is NASDAQ has decided to delay. So this is interesting because, we want it to fall. And you would think the best place for this thing to fall would be I want it to fall, would be at a supply. And look how far it is from a supply. And that's why I'm saying I think this is kind of like a long week, right? So markets are going to also have to look and wait for NFP. So tomorrow I'll be doing a lot of scenario analysis if I get 6 hours of sleep tonight. I am heavily tired. I'm very, very tired, but it's been absolutely worth it. S&P is rarely into elections. Sorry, so I don't know if you guys can see the comments on the stream there, but I'm just going to show this one so that we're reading together. Right. So since our meter month on S&P is rarely into elections, mid-month retrace and right into November. Basically, completely agree with that, man. Completely agree with that. So yeah, it's gonna be a blast, right? So Powell's gonna show up now. The sound audio quality might change a little bit. Do let me know. I have no idea if there's load shedding in my area. Normally when there is, I'll still have power with my inverter, but my Wi-Fi gets very weird. So, just bear with me. The crux of living in Africa and having idiots run the country. Right, so we've got about 3 minutes left. If you guys got any questions, any charts for me to look at, let me know. Of course, we have to talk about the dollar. I'm still a big buy dollar dips, right? So USD, JPY, I'm looking for those dips. I'm patiently waiting for clarity into dollar strength, but you can see our dollar has been slowly but surely trying to carve out, some room to move. That demand that we marked out still holding. The dollar itself is consolidating. Look at this. So someone is right and someone is wrong. Bitcoin, Nasdaq, S&P, US 30, Ethereum are all consolidating as if to go up. Well, there's the dollar as well consolidating, and this to me looks like a PCP. We could zoom in for days and find out if at all that engulfed properly, right? Whether it did or it didn't wouldn't matter right now. But this to me is a nice consolidation pattern right here, right? So the dollar is deciding it could fall based on Powell's words, or it could continue to go up, right? So everything is just waiting for Powell, right? This is kind of like, no one man should have all this type of power, but it's exactly that. Powell has to decide if they're going to deal with the problem now or kick the problem into the future, right? It's that simple. Please remember, this is not a bearish engulfing pattern over here on the left, right? Please, that's important for our strategy, right? Because then we can make terrible decisions, terrible decisions. Okay, very soon he's going to do the scripted intro. Again, my style of doing these things, if I feel like there's something crazily technical that I need to explain, I will pause, and break it down. So, bear with me if you kind of like already understand everything. Do you think the recent Q in Europe has started again can overtake the dollar? Nah. No. I think they still. I think the dollar, while I still believe Powell started off very late, right? Rating hikes and taking this whole thing seriously and turning off the printing machine, I still think, in terms of gaining ground, the dollar is way ahead. I think. I did see, Bank of England's decision is coming up, or has already come up. I know. ECB has also been on it, but I do believe that the dollar is slightly ahead. What could kind of like shift, balances if sentiment completely changes, because I'm pretty sure Eurozone is dealing with energy crisis as well, right? So they've got the gas problem, energy crisis. America has got the Fed/inflation problem. But I personally right now honestly don't have enough data to actually say Europe could overtake. I think, and again, America's are so the Fed specifically extremely stubborn about this whole thing. Even their blueprint papers on introducing digital currency, you can see they're still hanging back. And by the way, I know it's time to start. By the way, please keep track of any type of crypto headlines, right? There's a lot of debate behind the doors on crypto legislation. I'll do a video on that, sometime soon. If you can hear Powell, just give me a second. I can't even hear him. What's going on?
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It takes time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we'll take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Woo!
Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal, longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
Aggressive.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do
Markets hate
our
this.
public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith, Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lag effects that you mentioned?
So a couple of things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We'll be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. But would you say that the bias right now is not for another 75 basis point increase?
So, what I want to do is put that question of pace in the context of our broader tightening program, if I may, and to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to take the policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we've raised that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement, because that really does become the important question we think now is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy, as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. We'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that.
Yeah, what did he say, bro?
Was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Sorry, guys. I mean, I don't want to pause after every question, but he said nothing, hey? He literally said nothing. Markets went up, then wicked off down again. Like, did you guys see that? There was a classic wick there, like on the 1 hour time. He literally said nothing. Maybe this December, maybe the next one in the future. Basically, remember, markets hate uncertainty. You rather tell them right now, more pain. That's clear. Or, yeah, we're done, right? But for me, he's tiptoeing. All right, but sorry, I'm just yeah.
Nick Shemaros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
Follow up. What is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. There are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people publish an assessment.
taking our questions. Dina Smiley with New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down 2%, get it behind us.
Sorry, Paul is buffering. I got you, man.
That's what we really need to do and what we're strongly committed to doing.
Oh, God.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is, it's a commonly for a long time thought that monetary policy works with long variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before in expectation of monetary policy. That's the way it has moved for a quarter of a century. It's in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas
if they over-tighten, they can use their tools to support the economy. That is going back to printing money. If they over-tighten, they actually have to kind of like re-inject cash into the markets, like COVID, basically.
Inflation under control because we don't tighten enough. Now we're in a situation where inflation will become entrenched, and the costs, employment costs in particular, will be much higher potentially. So, from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lags. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go.
It's very premature to be talking about pausing. It's very premature to be looking for a pivot point. It's very premature for me to be slowing down. He's spanking people.
See, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in September. Sorry,
Uncle EG, did you see the silver thing? Uncle EG for silver.
Economic projections, which updates that, but I would expect us to continue to update it based on what we're seeing with incoming data.
Powell, Neil Irwin, Vaxios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? The housing part of it. Yeah. So, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policy is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers. And I'm just curious, to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the With the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see. Vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought and that the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet. But we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's a room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tauchi from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%, core PCE inflation, which is a really good indicator of what's going on for us. That we see it is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that gives.
I'm sure they're about to end, but just real quick, man, just multiple time from analysis, that stuff in module 1, just go back to it. Some of you who have access to the course again, right? I know you want the new stuff, but make sure you've mastered the stuff. I don't want to teach tonight. I am so tired. But look at this. Markets cleared out all premature demands on the dollar. All right. For me, Powell sounds hawkish. For me, Powell sounds slightly aggressive. For me, Powell has put a lot of uncertainty. For me, Powell somehow navigated, dodged around, and also kind of said, I am trying to pause nothing prematurely. That's what I got, right? I'll sit down again tomorrow, listen to it with a fresh mind. But look at how, despite all of that, because this is all aggressive, to me, dollar should be going up. Dollar first buys low, clears down. Basic principles for the so-called fundamental trades, all that kind of stuff. These spikes, as emotional volatility moments in trading, will still bow down to supply and demand. We know that the lowest supply or the lowest demand or the highest supply is generally the most preferred. This is the only next H4 demand after the one that we mapped out in the war room. All right, there's this one in the gray zone inside the daily, and all of these were all simple, nice liquidity traps, right? And markets bounce here. Now, price could either fail this week into the London session tomorrow. We shall see. Unfortunately, I don't want to lie, I don't even have a pending order here. Like, I'm just watching markets move, right? So this is interesting. But let me know if you guys are hearing something different. But to me, Powell is just avoiding a lot of things. But overall, nothing has changed. In fact, the man said, we suspect that things could get slightly worse in these reports. So we shall see. But for now, we don't want to slow down. Let me know if you're hearing something different.
Provides value to the people we serve for the long run.
Sorry, so silver and gold, we're just trying to, take on that moment, right, when dollar was falling, right? But very soon, things will stabilize again tomorrow. I expect slow-paced consolidation tomorrow as markets prepare for NFP. And then as usual, we strike as hard as we can next week, all right? But if you think you're going to catch these markets via market execution, then you're crazy, all right? A lot of the trading psychology issues that people post about, and I've been following so many Facebook pages, half your trading psychology problems will go away, number one, if you freaking, attend the course, right? And registered students, it's going to be up on the site. Please, it's going to be up on the site. I got you. I'm enrolling all of you. I'm waiting for you guys to join me. It's going to be up here. All right. If you haven't joined us, join us ASAP. But half of trading psychology problems will go away, or the other half, through set and forget. If you guys make crazy decisions because you're linking your emotional control, which you've not trained, you haven't been trained to control it yet, with price action right now. And the brokers are playing games. These printed candlesticks always lag anyways. These are emotional candles based on what Powell is saying per minute. Tomorrow, you're going to get a new pricing in sentiment. If you want to avoid these problems, your first account for Forex that you must build must be a swing trading account based on set and forget. That means you are not there most of the time when the action is happening. For intraday trading, we'll then deal with that in the psychology course. But I feel like it's the same game today, guys. I could be wrong.
The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored and keep the public believing in 2% inflation by the things that we do, even at times when when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marcy with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosure. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that, so that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, things like that. So it's not inverted, and also you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation coming. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's pretty forward curve. So yes, we monitor it. You're right, and that's what I'm saying.
Please stop.
You also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, as we showed at the beginning of the pandemic episode. We can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can. You're realizing you didn't actually get it. You have to go back in. And then the risk really is that it has become entrenched in people's thinking. And the record is that the employment cost to the people, they go up with that's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on that. What's the level we need to get to for rates. And I don't know what we'll do when we get there. By the way, it doesn't. But we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
This is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did. Now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline. There's still some significant rate increases coming. At some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. But I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you would wanted to see? Is that a problem, or how much that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Yo, bro, I control those messages, right? Forget the rumors. Forget I don't know what that guy said. He said markets are receiving this thing, positively. I don't know what he's talking about, but I'm telling you that for me, again, Powell sounds like he's serious about this whole inflation thing. Yeah, and then guys, I promise you, all of you should have access to the videos, but I'll do a tutorial because I know, yeah, I spent like a lot of time making sure, but I could have made a mistake. US 30, baby, finally arrived at our first touchdown. So that means I'm now triggered. We shall see tomorrow. It's too early to celebrate all these sales, guys, because of NFP, right? So just trade sober, right? We're not in a strip club. We are building accounts, all right? So just trade sober.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
No, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to weigh, sort of balance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, and the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
I think there's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings. Also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is, and we know what our tools can do, and that's how we think about it.
Last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to, as you ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. It is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
Just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
All right, folks. Yeah. I'm gonna quickly, I'm gonna end the stream now because I'm tired and I'm not, in the right state of mind. But I promise to get back to you guys tomorrow. We're gonna do a tutorial on how to access all these videos. The way I did it, basically you get an email and then you create your own password, and as soon as that's done, you find a 365 on all courses or whatever, and you just enroll, and this should open up for you. All right, so you can see this. Most of you should have seen module 1, module 2 on the previous drive, whatever, right? And then once 50% of everyone is on, actually that's too long because I don't know when people are going to open emails and all that stuff. So I'm just going to do the 48-hour rule. 48 hours, please do register. Tomorrow I'm going to drop a tutorial on this kind of stuff. And then, everybody at their own pace, I guess. It kind of sucks for me because I really wanted to do it live with you guys, and maybe we can still find a way to work around this live thing. But from within 48 hours, there'll be a new lower tab here with module 4, trading psychology, with the new uploads. Because of how my day was today, I didn't do a video today, but the first video has already been recorded, right? So I'm going to start dumping them within the next 48 hours. I love you guys. Thank you so much for joining me tonight. I appreciate you. Register students, it's about to be about us, right? It's just going to be about the private group. Some of you don't even have the links to the private group yet. I'm aware of that. Nothing has happened in there yet, all right? So I'm going to send out those links to those of you who joined within the last month or so. Please look out. November, December, January, I want to tighten everyone's belt. All right, I want to move up a couple of people. It's not an overnight process. So I want to spend those 3 months really focused on you. I stopped my trading flow on the 15th of November, but I will be starting in the next 48 hours. All right, so really looking forward to growing with you guys. 365, shake my hand. Remember, NFP Friday. Please don't forget that. CPI next week. But to me, I think we've got a very balanced Powell who hasn't changed his mind. We've got a clean trading strategy that mapped out these zones. Literally, look at US 30, look at S&P 500, mapped out all these zones literally, give or take about a week ago, and on Sunday, I don't know. You do what you want to do. There's are all pending orders that I gave out. J225 was consolidated literally by the supply. It was just sitting by a supply. We're in the money. We're gonna maintain a good trading thesis, good trading knowledge, and we're gonna make bank. 365. Should we expect market to fill the weeks? David, it's really up to what we call them, influencers. So basically, we're gonna have to see the sentiment tomorrow, right? We're gonna check out headlines, and then we're going to use scenario analysis during the London session to see if those weeks are going to be filled. I'm not too pressed, David, about how markets are going to move tomorrow because I know NFP could change things again, right? ADP gave us a positive reading. Powell keeps saying labor is strong, blah, blah, blah. So, but think about it logically. If NFP is a beat, if ADP is right, strong dollar, equities fall. Equities have been given the sentiment to fall. All right. So for me, I'm looking at my daily charts more carefully. Look, look at this, right? A nice, clean, bearish engulfing pattern forming. Why am I looking at day 225? Because this is the first market that's about to kick off, right? As the US session comes to an end in a few hours, The Asian markets are going to be crazy. So I'm going to be looking. I'm tired. I know I should not be making any financial trading decisions right now. But, since I'm tagged on the first one, I might want to go again in here. We shall see. All right. Clear demands along the way. So it's kind of risky. But the big thing is, let's see the sentiment tomorrow. Let's see what happens Friday. All right. But these trades, we should kind of like all be in them regardless, right? Because we are systematic supply and demand traders. I appreciate you guys. You guys stuck around, right? If you are not in 365, register ASAP so that you can start with others in the next 48 hours. But if you don't start with others in the next 48 hours, you will always have access to the videos, blah, blah, blah. Appreciate you. Please don't forget to like, subscribe. You guys, I only have 500 subscribers on this channel. It's crazy the amount of bull crap information that was across the world, on massive trading channels, on massive headlines. And as small as we are, you would think we're controlling the markets. It's not to toot my horn. I'm simply saying, follow a good process and trust it. Trust the process. Shake my hand, man. I'm going to sleep. 365. Please enroll yourselves. Even if you can't see the videos, just keep enrolling so that we can start together. Good night. Goodbye, everybody. Bye-bye.